And welcome, everyone. It's exciting to have all of you here with us today, whatever time it may be in the world. It's our opportunity to take the chance not only to have this workshop given to all of you, but also to introduce one of our newest EIRs to all of you if you haven't had the opportunity to meet him yet. And so without any further ado, myself and Vardika are very privileged to be able to introduce to all of you Wilson, who has really come into the DMZ over the past month, give or take, to really act as an entrepreneur in residence around financial modeling. I think it's one of those things that no one does until they are forced to do it, whether by their accountant, their investor, or perhaps someone else on the team. And so we wanted to make sure that we had a chance for him to not only introduce himself, but walk over how he really helps startups. And since he's already had the opportunity to work with a few of you, it's really helped kind of inform him the common things that he sees. And so if you haven't had the chance to book with him, definitely encourage you to grab some time with him after this session. But once again, Wilson, it's our pleasure to have you here. Thanks again for not only doing this workshop, but joining the DMZ team. And we're excited to have you.
Great. Thanks so much, Shane and Vertica, for inviting me here today. Really looking forward to meeting all the different incubators at the DMZ. I've already met with 5 of you in my short time frame, and some of the things that you guys are creating are just out of this world. So really happy to be here, really happy to be working with you, and I hope that I get the chance to demonstrate my skills and pass that along over to you guys. So a little bit of a, I don't want to keep this too formal here. I'm just trying to see if I can get rid of this. Nope, I can't seem to get rid of the toolbar on the top. But so today we're just going to talk about, a bit of my background, what financial modeling is, how to build your model, and some of the things you need to think about. And as well as how do I help during that process? How can you leverage me and how can you use me during that process to make it easier for you? And ultimately, going into your seed round raise or your investor discussions, much more prepared than what you're typically used to, because you're probably not a finance expert or a Excel whiz or anything like that. You should focus on your business while I help you on the financial side of things. So a little bit about myself. I spent 3 years at Deloitte back during the Great Recession. So I got hired in 2009. I did my 3 years there. I articled, got my CA, and then I went to industry for a little bit to be an accountant. Didn't really like that, so ended up coming back. I went to PwC in the deals and consulting practice. So I worked in corporate restructuring for the last 7 years. So that's essentially turning around businesses, trying to help them through difficult times, when they run out of cash or when they didn't pivot fast enough, trying to work with the lenders and stakeholders to, either, let go of certain departments or to refinance or to sale lease back, buildings and get that cash flow. So during my time, I've worked on, a $5 billion oil and gas company in Colombia, headquartered in Canada, operations in Colombia. So we flew down there, we took a look at the cash flows, we worked with stakeholders to eventually sell that business in a record, 9 months, for nearly $500 million. And this was during 2014 when the entire oil market crashed. So it was really interesting just seeing, the different stakeholders who's involved and dealing with all the politics and the personalities. And in that whole restructuring space, you deal with a lot of challenging situations. You're putting fires out all the time. You don't know if you're going to make payroll. You don't know if cash is going to run out. You don't know if an interested party who was going to buy you out, ends up leaving the table, waiting for you to crater so that they can buy you for cheaper. And so you're probably sitting there, you're like, wow, you're talking a lot about restructuring. Like, why, we're a startup. I'm supposed to be, full of life and energy. And so where my skills really come into play is looking at that financial model, looking at cash flow, forecasting, analysis, doing budgets and variances, because you are at a phase right now where you are probably, if you haven't already, at some point, even after your raise, you will be burning a lot of cash until you are profitable, because you'll get that, half a mil or a mil or whatever your raise is, and then you will slowly start to hire a whole bunch of people and spend money on R&D, and how long will that cash last, right? And that is the same skill set as what I'm used to in the restructuring world, is just trying to manage expectations, manage profitability, manage stakeholders, and dealing with the banks and lenders, and giving them an update and explaining to them what's going on. So that's kind of me in a nutshell. So I got further designations. I'm also a licensed insolvency trustee with the government of Canada. So essentially, I'm the one that's physically allowed to take possession of companies that are going under. So the companies that I'm working on right now, with my company, is like Le Chateau as an example, Stokes out in Montreal. We worked on the Bonfield restructuring. So there's a few of the big files here in Toronto. Me personally, just for fun, in the tech side of things, I love blockchain and crypto. I've been, mining cryptocurrency since 2017. At one point, I had over 18 video cards mining, and my apartment was very hot during that time. And and then it became not relevant through 2018, 19, and 20. Nobody cared about it, and then all of a sudden, it's back on everyone's mind. So it's kind of cool to see what's happened. So I just like to dabble in anything finance, trading, investing related. So if you ever want to chat about that, always happy to as well. So a bit of a long intro, but I will move along now to what is a financial model. So as we start to go through this, I do have a template model that we'll be kind of walking through as well. I will pause after each slide in case you guys have questions. This way, we're dealing with it in real time, and I don't do a demo and then you forget what I talked about, later. So just feel free to raise your hand or just to ask me questions. So what is a financial model? Financial model is a forecast, typically 3 years to 5 years. I like to build it on a monthly basis because, especially as a startup, you can't, in my opinion, you can't annualize your financials. You can't have 2021, 22, and 23 and just say, yep, that's it. There's no backup, no support, because there's that ramp up period. So I like building monthly financial statements, monthly financial model, and we'll go into that in a little bit. But a model is a tool that is used to make corporate decisions. It is also used for project finance. You might have heard of net present value. That is essentially where you take all your cash flows in your model and you apply a cost of capital, is what it's called, and you figure out, okay, is my net present value, NPV, positive or negative? And if it's positive, then it's like, yes, go ahead with whatever thing you're going to do. So if you're going to expand, if you're going to buy, an equipment, a asset, is it going to generate me positive NPV? Then do it. And then obviously if it's negative, well, I'm going to make this decision and it's going to lose me money even after I factor in, the lifetime, cash flow from that asset. So don't do it, right? So that's what project finance is. You also build a model, which is what you're going to be primarily used for, is M&A and capital raising. So you need to build this model to figure out what your enterprise value is. Enterprise value, in short, is essentially your valuation. And that valuation is what's driving, how much equity you're going to give away to your investors. It also gives you a frame of mind of, if investors start to come back at you, like you see in Dragon's Den, and they're like, I want 49% of your business, and valued at $2 million, and you're like, no, my cash flows and my model tell me that my business is actually worth $10 million. So I'm only going to give you 20% of the company, or whatever the number may be. So that's what building these models are useful for. I will move on. So steps in building your financial model. I think before we go into this, I want to show you what a simple model looks like. So I worked with a few of you so far. You know, some of you have very good Excel skills and have built a tremendously complex model, and some of you, you know, have not even, you know, gone down that route yet. Maybe it's too early. Maybe you haven't validated your idea. Maybe you haven't sold anything yet, so you haven't really put some thought behind it. So I'm going to show you two different models, and you know, I'll clean this up before we send this out as a template. But essentially, even though I said I don't like annual models, you need to at least have something so you have an idea of what your business looks like. So it's essentially broken up into, you know, kind of four segments, I want to say. You have your assumptions and drivers. So as I mentioned, so assess what your key assumptions and drivers are, and then forecast your income statement to earnings before interest, tax, depreciation, and amortization. And we'll go into this in a little bit. But this is the most important line that you need to care about, because that is what every investor, every lender is going to look at. That is essentially your earnings from your operations. So typically what I've seen so far is you're losing money in the first 2 years, and then, you know, you start to get that traction. People are signing up, people are paying for whatever you're selling, and then it starts to really grow. So this is the most important line, and we need to figure out how we get there. So first we have to think about, okay, well, what is my revenue? So and how do I plan for my revenues to grow? So this model is pretty simple. Everything down in these areas from your balance sheet and cash flow is all driven from these blue texts here. So you need to just think about in your mind, okay, if in the first year I'm going to make 55 grand in revenues, you know, what do I want my next year growth to be? And can I justify that? And when you look at this, you're like, okay, you just plugged in some number here, 1,000% to make it go to 600 grand. This is why I don't like simplified models, is because there is no basis behind why you're going to get there. And and as you can see, the tabs over here, I have a much more complicated model, which I'm not sure we'll have time to get into, but I'll show you how that's built out. But if you just want something to play around with just in the beginning, when you're trying to figure out, okay, is my business viable? You know, maybe in the top of your head, you'll do some back of the envelope math, and you'll say, you know what, maybe I can get, you know, 4 million in revenue, right? And then you start playing around with the assumptions until you get to where you want. And so you have your sales growth here, you know, you take a look at what the gross margin is. And a lot of these assumptions that we have here, you can just Google that. So, you know, look up, I'm an e-commerce business. What is the average, you know, gross margin I should expect in a SaaS business, you know, where I have annual recurring revenue and whatnot. And I actually had to do that research myself. And it's typically somewhere between 85 and 95%. So as you're building out your model, you start playing around with the expenses until you figure out what a good number looks like and whether this looks reasonable or not. So you're going to play around with the expenses. And, you know, this is why I said I don't like simplified models, is because, you know, you're kind of arbitrarily fixing your expenses and you have no idea what the basis is. And then if you present this to an investor, they're going to say, well, how did you come up with 1,000%, you know, gain in the first year? What is this 600 grand made up of? So we'll get into the detailed one sooner, but this is just a easy simplified model just for you to play around to figure out what the numbers could look like. And then we can actually sit down and then go into the details to figure that out. So I think I said a lot there. So I'm going to pause there if anyone has any questions. And if not, then I'll dive into the actual complicated model. Okay, give it another 5 seconds. Okay, so when I build a true model, so like let's go back to revenue, and revenue, as I will say before, I think of all the things that you need to nail down in your assumptions, revenue is the most important one. It is because you are trying to explain to the investor how you are growing, whether you are able to commercialize what your product is, and how do you intend to onboard more and more people to achieve that growth. So I was working with one of the startups here, and I zeroed it. I redacted everything, but if you're on the call, you might recognize this. So it is a website platform, and we're trying to figure out, okay, how many visitors do we start with? And so on beta launch, let's start off with 300 visitors. So from there, as some of you will know, you'll have a conversion rate. So a conversion rate is they need to click and do something. So whether it is buy something, whether it is to sign up for something, or become a lead. And then what is the chance to close that deal? So maybe there's another action that needs to happen. So that person signed up for whatever that action was, and then that gets forwarded along, and now you have to close that person. And so maybe every time you close a person, that deal is worth 5,000. I'm just making this up, right? And so it's 5,000 bucks for the deal. So when I build this out on a monthly basis, I like to first off say, let's use real months. So a lot of models that I've seen so far have built 1 to 36, or 1 to 60, which is essentially 60 months. But I need to know when that month starts. So in your inputs tab, when I build it, I can now change this that, oh, maybe you get your capital raised in August. So I want the model to start in August. If I press August and I go here, then all of my revenues and all of my expenses get pushed out to August. So now the model is flexible, and I can then change the cost as I see fit. And most of you are trying to raise now, so let's just keep it to July. So as I said, the base is 300%. I have a growth rate. I expect the leads to be this. I had the chance to close on that lead, and this is where you have to figure out what those drivers are for yourself. And this is how we start to build the revenue. So as you can see, the revenue starts to grow and grow and grow. And now this looks a bit more realistic when, I take a look at my summary and, I see that growth in revenue. And if an investor were to ask, well, how did you come up with that number? You can now point to, well, I expect to start my business with 300 people visiting my site. And I expect that number to grow every single month by 25%. And I expect that, to decrease over the 5 years. I expect to convert each customer that visits, at a 1% rate, which is somewhat, comparable to what we see in e-commerce business, somewhere between 0.5 and 2.5%. And then, what's the realistic likelihood that you're going to close the deal, and how much are you going to close it? So that is your driver for revenue. So if an investor asks you, at least you have support. You have some kind of basis to explain to them how it works. It is much better than saying, oh, well, my growth is, going to be 1250 from FY22 to 21. And then they're going to sit there and grill you on that. And you're going to be fumbling, your hands on like, okay, well, how did I come up with that 500 grand growth? Right. So that is why I think the simplified form is good for you to get started. And then we can work on building a more complicated, not complicated, but more detailed approach on a monthly basis, so that at the end of it, I can figure out how you got to where you got to. So again, when we get a chance, I want to save time for questions, but when we get a chance, we'll go through, your revenue, what your assumptions are, what your cost of goods sold might be. So, do you have AWS hosting? Are you hiring people for, customer success and customer support? What is your payroll going to be? And actually, I got this from one of the other startups, and I really liked, how they built out payroll assumptions. So you can actually, I'll give you this template, and when we work together, all you simply need to do is figure out, okay, um, I'm going to hire, who are you going to hire to start your business? Do you need software engineers? Do you need business development and marketing people? Do you need just office staff? Once you get more than 15 or 20 people, should you start thinking about hiring a VP HR? Do you need a chief technology officer, chief, marketing officer? Who do you need? And when do they get hired? So we built this in a way that I can now just say, okay, well, I need 3 software engineers right away. I don't need, another one till 6 months later, and then another 6 months and another 6 months after that. And you can actually model that in. And like I said before, when I set up the model and you don't know when you're going to get your capital raise, I can then move that start date of your operations out further. Maybe right now you guys are taking a bunch of sweat equity, you don't actually have any employees, and you're like, you know what, I'm not going to pay employees until January 1st, 2022. So then I can move that out. And because I have the starting months here set, you can change this. It'll automatically move all that payroll cost out. So once you do that, and it flows, and then it will flow into the model, in the grouping that it's supposed to be in. So management, sales and marketing, general and administrative, research and development, all that payroll cost will sit there. And ultimately your goal is figure out, to the best of your ability. And, we often joke about financial modeling and forecasting, that the only time your forecast is right is literally the minute that you create it, because it'll be wrong anytime thereafter. You will never meet your forecast. Something will always change. And, one quick thing I will mention, if you guys, for your own personal spending, if you have your own budget, like, $1,000 for accommodations, a few $100 for groceries and this and that. How many times at the end of the month are you looking at your credit card statement and you're like, how did I spend more than what I budgeted for? Like, where did the money go? And it's like this $20 fee here, or like you signed up for Audible and there's another $30 there a month. And it's the same thing in business as well. Like, you have to be conservative on both sides. You have to be conservative on your revenue. So as much as I like to see a giant hockey stick in your growth assumptions, you have to, look at that and say, okay, is it reasonable that on an annual basis, I will hit 7 million by the end of year 5 if I'm starting out with 500,000 next year? And then, am I forecasting enough cost that, if I grow to a $7 million business, did I grow my payroll fast enough? Am I hiring enough business development people and marketing people and customer success people to manage that growth? I'm sure you've seen, if you're an investor or, in the crypto world, like, you see all these stories about the exchanges crashing is because they didn't expect that traffic and that order flow to go through. So are you investing in AWS and your hosting fees, and have you accounted for that when you're growing your business? So, we're going to work together on erring on the side of caution. So do I need to increase all of my operating expenses and be more conservative on my revenues? Because you just never know at the end of the year, if you end up spending way more than you need to, Because the last thing you want to do is raise the money and then 6 months later go back to the investor and like, sorry, the forecast was wrong. I need another $1 million, right? Like that just doesn't, it doesn't feel good for both parties. It makes you feel uncomfortable. And so that's what we want to try to avoid. So, you know, and I'm trying to balance that as well. You know, I come from the corporate restructuring world, which is way more conservative. You know, I'm always thinking too doom and gloom, whereas, you know, we got to balance that super awesome growth, hockey stick trajectory, but balancing that with, okay, do I have enough cash to actually make it through the next 18 months? So I've said a lot. I've showed you a lot. So I'm going to pause there before we move on. If you guys have any questions.
Let me jump in here with one. So I think one of the ones that I've personally seen a lot of folks struggle with is kind of presenting a best, worst, and kind of middle of the road scenario. And so how often should you kind of plan out having the, if we hit everything or exceed everything, this is what happens. This is what happens if a global pandemic happens, for example. And then of course, the more kind of like, and this is what happens if we're, you know, kind of on track. When should you start to think about having those types of scenarios built out?
I think it's a good question. I think everyone should have a base case, worst case, and best case. So, and I think that's more of an internal tool that you should keep in the back of your mind, because obviously you want to go to your investors or your pitch with your base case and best case. And your base case is what I said. It's that nice temperament between moderate growth or achievable growth and you know, conservative operating expenses, so that you have a good understanding that, you know what, if we are status quo and, you know, I'm winning contracts and this is the way that life should be, then I think reasonably I should be able to get here. Now, then you build a best case where it's like, okay, actually, if we land 3 more contracts, this is what the awesome case should look like. And I think having those two in your pitch deck or in your proposal or whatever you're using this tool for, I think that is the right approach when you're dealing with investors and when you're trying to raise money. Having the worst case, which is like the pandemic and like, you know, we get hacked, or, you know, I lose my code, or, you know, my co-founder quits on me. I think you should have that in the back of your pocket just to see what the numbers would look like, and just to see, okay, if I'm going to run out of cash in 18 months, but if all this bad stuff happens, I could actually run out of cash in 6 to 8 months. I think just having that in the back of your mind as a separate scenario is good, just so you're aware of what could happen and whether I need to go back to the table and raise more money. So again, it depends on how complicated of a model you want to build and that we can work on. But I've built models where you can have a toggleable function where it's like best case scenario, worst case scenario, blend of two, and having a base case. But, you know, very good question. And, you know, it's definitely something, you know, we should consider building when you're looking at your model.
I have a question.
Yeah.
Hey, Wilson. I'm Seth. I'm with Smart Term. I think you've worked with Iodel before. And
Oh,
maybe
yes,
Samir.
yes. Hi, guys.
Yeah. My question is, some of our startups, we operate in multiple markets. We have a couple of people who are like in Canada and the US. Smart Term is in the Caribbean and also looking at North America. How important is it, or when does it become important to kind of separate your financial models for different markets?
So I think the bigger question should be what, and I only know this because I've worked with you guys. It's what is the entity I am dealing with? So if the entity is, in your case, Smart Term, you know, Canada, and we're dealing with the Canadian entity, and we're not dealing with the consolidated entity, which is two different things. So if it is Smart Term Canada and it's a Canadian entity, but it has revenues from other jurisdictions, so other countries, then I would have separate tabs tracking, if there are separate costs and revenues associated with that. So it's almost as simple as, copying this model, moving it, making a copy of this tab and saying, okay, this is Canada, this one's US, this one is UK or wherever else. Because if you have identifiable revenues in that country and you have identifiable costs, such as I am hiring people in those countries, I am dealing with costs and legal and accounting in those countries, then yes, you should keep all of those tabs separate. And then maybe you want to have a consolidated tab where then all three tabs then add up into the consolidated group tab. But if you are only just selling to those countries, just revenue, just top line, I'm thinking in my mind, like if it's like an e-commerce business like Shopify, and you're just saying, oh well, 25% of my revenue comes from US, but no cost is incurred in US, i.e. I order everything from China anyways, and it just gets delivered to US, and all my head office operations is in Canada, then I would just have a revenue stream, like just one line here being saying USA revenues, right? Because all of the cost is still in Canada. There is nothing else, incurred in the US. So I don't think there's a point to make it more complicated than it needs to. In that case, I would just have a USA revenue line. So yeah, hope that answers your question.
Yeah, definitely. Thank you.
Perfect. Okay, let me know if we're good and I can just continue moving on. So we kind of talked about this. Forecast your balance sheet, calculate your cash flow. I think it's a bit much for today. And so part of like being an EIR, we can sit down and I can walk you through this in more detail. Key drivers for your assumptions, some things you need to think about: site traffic, conversion rates, churn rate. Most of you have already started to think about this, obviously from just a business point of view. So now let's convert that into financials. So like, what does that actually mean? Like, how many people do you expect to visit your site? How many people do you actually convert? What's the average revenue per user? And most of you have done this. Like, what's the market I'm trying to go after? And what's that small percentage I'm trying to get from it? So how much money should I actually make from doing this, building this business that I'm building? So most of you already know this. How to value your company. So this is also a very interesting thing. So disclaimer, I am not a chartered business evaluator. At some point when you guys get big enough and you start to raise big money and you are getting heat from your investors on your valuation, highly recommend hiring a chartered business value, CBV. It is the same as when you go for real estate and you're buying a house or you're buying property. There's a specific realtor valuator called, I think it's AACI. Like you're looking for people with that experience. You're not looking for your average Joe realtor to tell you what the valuation is, like $1,000 a square foot. Like you can't rely on that. You want it to come from someone who actually understands your business, takes a look at comparables, takes a look at what else is going on in the market. But at a very high level, like I said before, EBITDA is the most important metric. And so EBITDA, most of you will have negative, positive, big positive, right? And then you take your taxes off of that, and then you take off change in working capital. Change in working capital is like, are you accruing a lot of accounts receivable? Do you have a lot of accounts payable that you need to make? And then we can walk through this when we get a chance to sit down. But essentially you take, again, remember, like I said, net present value of that forecast. So you take all 5 of these values here, most of them are negative, and you have one positive here. and you discount it by 20%. So 20%, what that means is your cost of capital. What that means is someone was to invest in you like a lender. How much interest would they charge you is essentially what they're doing. And because you are a startup, you are not, your business has not been, validated, you haven't reached that commercial viability yet. Somebody who is investing in you would say, you know what, I want 20% interest because this is highly risky. Whereas, if you're a mature business, you could go to the bank and the bank will be happy to give you 4%, right? So that's what the big difference there is. And what that ends up doing is that really shrinks the value of your company. Now, here's what's fun for most of you guys in the SaaS and the recurring revenue space. EBITDA multiple. So what they do is they take the terminal value. So if you have a 5-year forecast, the terminal value is year 5. So you take this, you take your EBITDA in year 5, so 8.8 million, and you apply a multiple. And the multiple you can get from other comparables. Maybe there's a public company out there that does what you do. Take that metric and apply it to your EBITDA, and then you apply that multiple, and that's how you get your valuation. So, or your enterprise value. And so then you take your enterprise value and divide it by EBITDA to figure out what that multiple looks like. So without naming names, I was working with a real estate incubator, one of you guys here. And the easiest way to figure out what that multiple is looking at public companies. Hang on, give me a second. I just want to show you. So this thing I use, Atom Finance, is free. So you compare. So I know for a fact Redfin is a digital real estate company or platform listing company. Another one's in China called Beke or KE Holdings. And so when you add those two there, you have enterprise value over revenue, enterprise value over EBITDA. And see, these guys are also high growth companies who are probably spending a ton of money. So their EBITDA is probably small, but their enterprise value is high. That's why this multiple is so big. And so when you go back to taking a look at, okay, does my valuation divide EV versus over EBITDA? Does that make sense? Like if you calculate that number on a small EBITDA, so right here, 28 million on FY23 EBITDA, that would be, I don't know, 100 times or 400 times EBITDA, or maybe EV over FY25 EBITDA, which is 28 million over 8.8. That's what, 3.4, 5.4. So, okay, does that seem reasonable? And then when you look at these public companies that have 75 times multiples, all right, maybe I am, my company is valued, appropriately. So that's how you start to think about, is the valuation of my company reasonable or not? So again, we're using this financial model to figure out, okay, revenues minus expenses equals earnings before interest, tax, depreciation. Then what I do with that number, okay, I'm going to try to figure out what my valuation is. Okay, why do I care about that valuation number? Well, then it's time to look at the multiples and how do I compare against my competitors that are out there? So that's kind of like how I think about financial modeling. That's why it's important when investors sit there and they grill you on, one, all your assumptions that you're putting in, two, what your valuation is, and three, they're going to try to grind you on that valuation. They're going to try to get the best deal they can out of you. And so if I arm you with this information, including comparing to public companies out there, you will be able to sit in those meetings a bit more confidently and comfortable that you can defend yourself when you get raised those questions. I mean, we all watched Dragon's Den. How many times have you seen how uncomfortable those the entrepreneurs standing up there are when the dragons ask these just very simple questions? How do you come up with your revenues? How did you come up with that valuation, right? So that's how we get here, and that's how we so just going back to what do interested parties look for? valuation, what you're looking for, the amount of equity you're giving up. The two other things. So I've talked to BDC and I've talked to Silicon Valley Bank just recently last week. And I asked them, I'm like, all of these companies are startups. They all have hockey stick, year 3 profitability. What do you guys look for in terms of validating? And they said they want to see who's the management team. Do you have the experience in the field of the business you're building? And second, who's backed you? Is it another venture cap? Do they have trust in you? Then okay, that's probably I'm investing in the person. So that's kind of so I'm going to pause there for a couple of minutes and see if you guys have any questions.
Hi, Wilson. I'm not sure if you can hear me. Can you hear me?
Yep, I can hear you.
Okay, awesome. So I'm from Ally, and we actually have a meeting booked with you. So super excited to work with you on this. I was just wondering, since our business, so we're a mental health platform for parents, and the comparable companies for us are all private. I can't really think of any that's public. Where would you look for that kind of information for the multiple if they're private companies?
Like off the top of my head, the ones in the state. So I know US isn't a good benchmark because US, there's just so much more money flowing into businesses in the US. But off the top of my head, and it's because I'm familiar with this industry as well, like Mind Beacon is a Canadian company that IPO'd. One of my friends that works at LifeSpeak, they're IPOing in two months. Lyra Health down in the States recently got valued at $1 billion as well. So, there is information out there even for private companies, but it's mostly in the States. So Lyra Health, as an example, recently raised at 2.3 billion. Like, this is their valuation right now. And I'm trying to see, let's see, financial and metrics. Yeah, it is tough when it is private companies and you don't know what the valuation is because all their financials are private. So the only alternative is, as you are going to these pitch meetings and you're meeting with venture cap companies, sometimes they talk about their portfolio companies, and they might have metrics there where you can try to see if you could get that to compare. But generally speaking, I think there is information out there, especially in the States, that talks about just the growth in the mental health funding space, from 2010 all the way to now, how much it's grown. Like there's bound to be information, and we can work together to try to figure that out as well. But yeah, my recommendation is try to see if there is any comparable public companies where you can try to get that information. Even if it's one or two, at least you have some kind of benchmark there, even if your business is not completely the same.
Okay, thanks so much.
Sorry, I know that's not the best answer, but even as a professional, sometimes you struggle when everything's private as well, and you're trying to figure out what that comparable is. So that is a difficult thing. That's why if there is no comparables, that's why getting someone like a CBV who will then actually dig into your business to then figure out, okay, are there different valuation methods that I can use to value your company? One method is actually, a replacement cost method, which is essentially saying, if I hired all the same people to do this, how much would that have cost? And so that would be your floor value of your valuation. So essentially that is somebody coming in literally just paying for you at cost, or is there other ways? So we can dive into that if we really need to, but essentially I'm pretty sure you should be able to find one or two public companies out there to at least guide you in that direction.
Okay, awesome. I'll take a look. Thanks.
Cool. All right. And we're running out of time here. So how to book time with me? So you can book a 1 hour virtual face-to-face through Calendly. And because I'm a tactical EIR, each booking includes 1 extra hour of what I call do work time. And so with some of you that I've worked with, you said right off the bat that, okay, I don't need my model done for, a few months. We're not looking to raise right now, but I just want to start getting my head wrapped around it. So what we've agreed there is I will just meet with you every week for half an hour. And then I will use that hour and a half to actually continue revising and building your model. So, that is an option that we can do. The other thing that, has worked well is, just give me your model and I will just review and put comments in there and then send it back to you and then you fix it. Because at the end of the day, you're most familiar with your model. And, I don't want to change. I try not to change too much that then you don't know what's going on and you don't want to break it and you're afraid to touch it. I don't want to get to that situation either. So really, I'm in your hands. Essentially, I'm supposed to do 2 hours per startup, up to 4 startups a week. So my max is 8 hours during that time. And so you choose my level of involvement. So review, comment, or build and design. So it's up to you on that. So I'll pause there. Shane, or Vertica, if you guys want to say anything on that, feel free to jump in.
No, I think what we can do is kind of end the session in the sense of I'll stop the recording, but we'll leave some time for some Q&A. So the Q&A will get to be the bonus that you only get to experience if you're here. And so thank you, Wilson, for the presentation.